Personal loans are one of the most marketed financial products in the modern world. Banks offer them, apps suggest them, stores partner with lenders to make them available at checkout. They promise convenience, quick approval, and easy monthly payments. But behind the friendly marketing, a personal loan is still a structured commitment with interest and obligations. Understanding how it really works helps you decide when, or whether, to use one. At its core, a personal loan is an unsecured loan you take from a lender for a fixed amount. You usually receive the full amount up front. Then you repay it in fixed monthly installments over a set period with interest. Unlike a credit card, the loan amount and the term are decided in advance. Unlike a mortgage or a car loan, no specific asset is used as collateral against most personal loans. This matters because the fixed structure looks reassuring. The monthly payment seems manageable. The total amount feels limited. But every small choice inside the loan affects what it really costs over time. The interest rate, the term, the fees, and the way you actually use the borrowed money all decide whether the loan is a useful tool or a quiet long-term financial burden in your life. To understand how it really works, picture three numbers. The principal, which is the amount you borrow. The interest rate, which decides how much you pay for the privilege. And the term, which is the number of months across which you repay. The monthly payment is set so that, by the end of the term, you have repaid the entire loan plus all the interest the lender expects to earn. Let us look at a simple example. Imagine borrowing $5,000 at a moderate interest rate for 3 years. Your monthly payment may be around $150. By the end of the loan, the total amount you have paid back might be $5,400 or more. The extra few $100 is the cost of borrowing. The structure looks small per month but slowly accumulates over time. A common mistake people make is borrowing for everyday expenses. Personal loans are often used to fund vacations, gadgets, weddings, or lifestyle upgrades. The borrowed money is gone within weeks. The monthly payments continue for years. By the time the loan ends, the experience has been forgotten, but the obligation remained part of the household budget for far longer than expected. Borrowing for consumption is rarely the wisest financial choice. There is also a hidden risk in how some personal loans are structured. Some have prepayment penalties, which charge you for paying off the loan early. Others have variable rates that can rise over time. Some include processing fees or insurance bundled into the loan. Reading the full loan agreement carefully is more important than the friendly summary on the marketing page. Quiet details often shape the real total cost. A useful way to picture a personal loan is as a future payment you have promised your future self. Today, you receive a lump sum and feel relief or excitement. Tomorrow's version of you must work to repay that promise, month after month, regardless of what life brings. The smaller the loan and the shorter the term, the lighter the promise. The larger the loan and the longer the term, the heavier the commitment. A second key idea is the difference between productive borrowing and consumption borrowing. Productive borrowing funds something that improves your future earning power or financial position, like certain types of education, key business investments, or essential repairs. Consumption borrowing funds something that simply gives temporary pleasure. The same loan structure can serve very different purposes, and the wisdom of taking it depends largely on what the money will actually do. A practical example helps. Imagine someone using a personal loan to cover a serious unexpected medical bill they could not afford otherwise. The loan helps them avoid a much costlier emergency. Now imagine another person using the same loan to upgrade a working car for cosmetic reasons. Both loans look identical on paper. One protects financial stability. The other quietly weakens it. The decision matters more than the product. Beginners often misunderstand the role of credit history in personal loans. A stronger credit history usually results in lower rates and better terms. A weaker credit history can mean significantly higher costs for the exact same loan amount. Improving your credit before applying for a major personal loan can quietly save you a meaningful amount of money. Rushing into a loan without preparation can be much more expensive than expected. There is also a psychology angle. Personal loans are emotionally easy to take when you are stressed or excited. A salesperson can make the monthly figure look harmless. A friendly app can show approval in seconds. But emotions are not the right state for big financial commitments. Always sleep on the decision. Run the numbers calmly. Compare more than one option. A loan signed in a calm moment usually serves you better than one signed under pressure. A simple practical rule helps protect you. Before taking any personal loan, ask 3 questions. First, is the money funding something productive or just consumption? Second, do I clearly understand the total cost, including all fees and interest? Third, can I comfortably make every monthly payment, even if my income drops temporarily? If any answer feels uncertain, reconsider the loan or wait until your situation is stronger. There are things to avoid. Do not take a personal loan to pay off another personal loan repeatedly. Do not stretch the term just to lower the monthly payment without considering the total cost. Do not skip reading the full agreement. Do not borrow only because you qualify. Do not consolidate debt blindly without changing the spending habits that created it. The structure changes. The behavior is what truly fixes the underlying problem. A better habit is to treat personal loans as a last resort, not a default tool. Build an emergency fund so you do not need a loan for small surprises. Use careful budgeting and saving for planned major expenses. Reserve personal loans for genuine, well-justified needs. When you do use one, prepare your credit, compare lenders, and read everything. Used carefully, occasionally, the personal loan stays a tool rather than a trap. Over the long term, the way you handle personal loans says a great deal about your financial discipline. Households that borrow frequently for consumption often find their net worth slowly stagnating. Households that borrow rarely, and only with clear purpose, tend to build wealth more steadily over time. A single personal loan is rarely the issue. A pattern of casual borrowing is what quietly shapes financial life across many years. So here is the short version. A personal loan is an unsecured fixed-term loan with monthly payments and interest. The total cost depends on the rate, term, and fees. It can be useful for productive purposes and dangerous for casual consumption. Read every detail before signing. Use it as a tool, not a habit. The same loan can serve you well or harm you, depending on how and when it is used. If you ever consider a personal loan, do so calmly and with clarity. Define why you need it. Compare offers. Run the total cost. Make sure every monthly payment fits comfortably into your budget. Avoid using loans to fund lifestyle inflation or short-term emotional purchases. Used carefully, a personal loan can solve an important problem. Used carelessly, it can quietly create a much larger one. The choice belongs entirely to you.